of the tenets of Warren Buffett was that the business the company is in should be simple and understandable. Okay, so he did not understand IT, so he did not invest in it. Doesn't mean that IT is a bad sector to be in, but just
मेरा यहाँ
that's the
कुछ नहीं
call
चल
that he
रहा है
took.
ना FYI
If he doesn't understand it, he will not invest. Okay. Um, then the company should have a consistent operating history, which should be visible in the operating earnings that are stable and predictable. Okay, the firm should be in a business with favorable long-term prospects. Okay, so long-term, the business should have good things to look forward to. Okay. Okay, now this will probably answer some of your earlier questions on evaluating the quality of the management. So what Warren Buffett believed, what the managers of the company should be candid. So bad news should be given as actively as good news. So one of the companies
Hello.
that I believe that follows this. Yes, Sonal. Hello. Yes, Sonal. Yeah. So uh, one of the companies that I believe, at least in India, follows this is Infosys. They do really come out with bad news very frankly. Okay, so I think that is a culture that was put in place by Narayan Murthy. Warren Buffett also believes that the managers of the company should be leaders and not followers. Okay, so typically there are companies which start trends and of doing things, and there are other companies which follow trends. Okay, so which Warren Buffett believes reflects the quality of the management. Okay. Okay, so I see another question. Pritam, I understand that the political scenario, uh, like Britain exiting investors or people having business activities in Britain, I mean fundamentals getting affected. Will all political scenarios affecting fundamentals of every company, irrespective of whether investment business activity made there, like current political situation in Turkey? Okay, so see, do not go by do not confuse the stock market activity as being representative of you know uh, what is happening to the fundamentals of a particular stock. Okay, so see, the fundamentals of a company do not you know uh, change as frequently as the stock market. In the stock market, prices move every second. So does that mean that the fundamentals change every second? No. So stock markets, trading happens in the stock market because the stock market exists. Okay, so because people are there, they are trading. Okay, so stock market is a is an institution where money is transferred between people. Okay, no real value creation happens in the stock market. Okay, so because people are employed, they do trade. Okay, so there are people who are trying to make money every second, so they are constantly active in the market. Okay, so because of that, the prices are going up and down. It doesn't really mean that every thing that is happening in the world is affecting our market. Okay. Okay, so it is rarely at the same level at what the right fundamental price would be. Okay, so we are either over enthusiastic or we are overly pessimistic. Okay, so that is what keeps the stock market going, right? So okay, so now there are two types of factors that you look at in fundamental analysis: qualitative factors and quantitative factors. Okay. Now, within qualitative factors, you come across things like business model of the company, management, which we have discussed at some length, corporate governance, and comparative advantage. Okay, so business model of the company is basically before, as an investor, you look at companies' financial statements or do any research. One of the most important questions you should be able to answer and you should be able to ask is, what exactly does the company do? Where is the company making money? How is the company making money? If the revenue is P into Q, where P is the price and Q is the quantity, what exactly is that Q for is charging P? Okay, and how much control does it as a company have over what price is it charging to customers and the quantity that it is selling to the customers. Okay. Um, Comparative advantage is basically implies that a company is performing better than its competitors by either doing different activities or performing similar activities in different ways. Okay. So you have a public sector bank and a private sector bank. So we just saw IndusInd Bank had a PB ratio of 5, where Yes Bank had it at 2.35. So what are each of these doing differently for getting a different PB ratio? Okay. So that's comparative advantage. Competitive advantage is gained by unique competitive position. Okay, so you might be the absolute leader in the luxury segment. Okay, of a particular product. So let's say Apple. Okay, Apple is the complete undisputed leader in the luxury phone segment. Okay, which gives it a unique competitive position. Its margins will be far higher than competitors who are selling phones at 2,000, 3,000 rupees. Okay. Okay, so it might be giving clear trade-offs and better choices than its customers. Again, keeping the example of Apple, you can just name the phones that are available. Okay, so you take a decision: do I buy an iPhone 6 or a 7? Okay, or a 6s, which is very different from a company like Samsung. Samsung will have hundreds or 200s of different brands. Okay, which I don't know if anyone will know all of these brands. Okay. And so that is the competitive advantage. Okay. Um, so other thing is it will have the competitive advantage is also gained by activities which are tailored to the company's strategy. Okay, so Apple is a luxury product, iPhone. It doesn't need to, let's say, promote itself in cricket matches, let's say, for example. Okay, or and you know or a competitive advantage is gained by high degree of operational effectiveness. Okay, so let's say an ICICI Bank will, because it has a private sector, I mean it is in the private sector, it might have a lot of operational effectiveness, and which gives it a competitive advantage over public sector banks. Okay, so when a company achieves competitive advantage, its shareholders are the ones who gain. Right? The Infosys was one of the few outsourcing IT services providers from the country. So I see Infosys shareholders have been rewarded for that. Okay. Um, then management, we have already discussed it. If the management is bad, no matter how great the business, the company is doomed for failure. Okay. So the management quality can be measured through conference calls. Okay. Um, okay. So the CEO and CFO will hold quarterly conference calls. Then your management discussion and analysis that we discussed, which is found at the beginning of the annual report. Okay. Then the amount of capital held by management. Okay. So are they secretly selling their stock when the company is doing well? Okay. Things like that. Okay. The other qualitative factor that okay, I think there is a question come. If I notice a company with decent revenue, profits, decent expenses, debts, etc., company for 3-4 years, and qualitative understand on what business they are up to and valuation is within, is it good to invest in for long? Like a unnoticed company, but good in fundamental. See, the answer to that question is, see, 50 rupees is relative to what? So what is the book value of the company? When you say 50 rupees, it is just a number. Okay, so if you're investing in one stock, yes, it is a you can go too long. Okay, but what you should look at is what is the value relative to the um, you know uh, the yeah. So hopefully, Siddharth, that answered your question. Okay. So the other qualitative factors that you look at is corporate governance. Okay. So corporate governance basically describes the policies in an organization which define the relationship between management, directors, and stakeholders. Okay. So what is the management responsible for? Okay, what are the shareholders responsible for? That relationship is defined under corporate governance. Okay. Sorry, Siddharth, there is a question which is come in company structure. I don't know what you mean. You have to maybe you can just unmute yourself and tell me your question. No, I'm not. You have to unmute yourself and tell me exactly what is the question. Okay. So okay. So you have this combination of inside and outside directors, which attempts to provide an independent assessment of management's performance. Okay. So let's say if the board was entirely represented by uh, the board of shareholders was entirely represented by you know the directors appointed only by the promoters, then it they will take decision only for the promoter group in the company. So therefore it is, you would have seen it is uh, the government asked for independent directors to be appointed to the board of a company. Okay, so if you see the typical management-driven companies are L&T and ICICI Bank. They have a widely diversified shareholding. There is no single promoter group which drives the company. Okay. On the other hand, if you see a Wipro or a Blue Dart, okay, they will have a high promoter stake. Okay. So doesn't mean that necessarily high promoter stake companies are bad, but just to give you examples. Okay. Okay. Now quantitative factors, you look at obviously the industry. How do we find the price of stock of a company based on relative value is Siddharth's question. So see, price to book value is one of the you know the relative values which is used. Okay, price to book value we typically use in case of banks. So let's say typically um, banks are valued PV ratio. Yes, you're right. So let's say in case of banks, typically the PV ratio is 2 to 5, for example. Okay, and okay. So we call that because this company is at 0.5 PV ratio, it will increase in um, value. Okay, um, so they might decide to invest in that stock. Okay, but again, if there is no real logic which might explain why relative values will always be right. So public sector banks are typically, as we discussed, below the PV ratio of 1. Okay, and the reason is that the market believes that they have a lot of bad debts on their books. Okay, so it depends what kind of assumptions that what kind of conclusions that you draw from the PV ratio. Okay, so the quantitative factors that we were discussing is basically the industry growth. So for example, if you're you might be interested in the e-commerce industry because of the high growth that the industry is seeing. Okay, the you will how much the customers like the company. So what percentage of customers prefer the company, or you might look at what is the competition in the market. So vis-a-vis the competition, how much is the share of the company. Okay, and obviously the most important factor is the financial information of the company. Okay. Now industry growth basically tells you that if you are investing in a particular company, you are investing for growth. Okay, but if the industry is not growing, okay, then the you know the new customers of this company will come from existing companies, other companies, if the overall market is not growing. Okay, which is a little difficult thing to do. So you take the example of insurance companies. In case of insurance companies, because the industry, because the number of people who are still uncovered by insurance is high. Okay, there is a potential for this industry. Okay, so the companies need not compete among themselves to win customers. Okay. Achha, so now some companies serve only a handful of customers while others serve millions. Okay, so it is a red flag, a negative if a business relies on a small number of customers for a large portion of its sales. Okay, so that is why FMCG companies are in favor, because their number of customers are spread out. Okay. Okay, now competition, looking at the number of competitors, also, goes a long way in understanding the competitive landscape for a company. Okay. High price war, high competition might lead to a price war. Okay. So if there are too many, companies in the industry, it might, as it happened sometime back in telecom, it might lead to a price war. Okay. Okay. So okay. So are there any more questions? We have, some 5-10 minutes. We can 5-10 minutes more. Would you like to ask any questions? Any questions, generic on the market, etc.? I'll be happy to answer. You can just put it on chat, or you can unmute yourself and ask the question. Or anything relating to the slides also you can ask. Hello? Okay, so Siddharth asks me, what are the basic ratios? Let me just quickly take you through the slides on the ratios. Okay, so your follow-up question is PB/PE ratio, what should be the numbers for good buy? Excuse me. See, there is no one particular, ratio that might be useful. So PE ratio, it depends what kind of conclusion you're drawing from the PE ratio. So on the one side, it might suggest that the company is undervalued, but on the other hand, also it might suggest that the company has some inherent problems. Okay, so unfortunately, there is no one clear-cut, ratio which will, tell you which stocks to, buy. So unfortunately, there are absolutely no shortcuts to making money in the stock market. I'll have to tell you that. Okay, so there are basically 4 types of ratios. As you can see, there is profitability ratio, there is liquidity ratio, solvency ratio, and activity ratio. Okay. Profitability ratio, you have return on assets, return on equity, net profit, operating profit margin, okay, and EBITDA. EBITDA is earning before interest, taxes, depreciation, amortization. Okay, you can go through these. We can arrange to send these slides to you. I think you can go through these slides. Um, okay, so you can just glance through the each of these ratios. Okay. So I guess we'll have to end it here, guys. We can send you the PDF, okay, and then if anything there is, you can get back to Sonal if there is a requirement. Yeah. So Sonal, can we end it here now? Sonal, are you there? Thank you. We'll end it here.